Well, hello everyone, and welcome to the Wilson Pateras webinar for this evening, creating wealth through property in the post-pandemic market. So thank you all for attending. Of course, we have here with us today Mr. Michael Yardney. Good evening, Michael.
I was being polite and muted myself, Nicholas, so thank you. Good evening, welcome.
Fantastic. So as we know, this year's been a reasonably unusual year when it comes to investments and just life in general. So we have here today Michael to hopefully give you all a few more insights around what the property market perhaps has in store for us. We started the year well, it appeared, with property. There was some really strong results, and then all of a sudden COVID came along and really threw a bit of a spanner in the works. But in the most recent time, particularly here in Melbourne, we have a reopening of the property markets, and hopefully we can hear a bit more about Michael's insights about what could be happening. So this is an open forum, so to the extent that we would like you to ask questions, and you'll notice at the bottom of your screens, or might be at the top of your screens, is a number of different tools, and one of those is the Q&A tool. So we invite you to put forward any of your questions. I'll be monitoring the Q&A box throughout today's presentation, and we'll be trying to help answer or help provide Michael the questions to answer. If your question doesn't get answered throughout the course of today's presentation, we'll seek to answer those questions at the end. Today's presentation will go for roughly half an hour to 40 minutes, so there should be plenty of time for your questions. You'll also notice there's a poll button there as well as one question we've got in that poll. So please feel free to answer that poll, and we'll be able to go ahead and get a bit more insight around the type of participants that are here today. So Michael is one of those people who I recall seeing many years ago through Michael's activities, both in property magazines and also online and even on Sky News. So Michael has been voted one of Australia's 50 most influential thought leaders, particularly in property. And even though he's the best-selling author of 9 books, Michael isn't a theorist. He's a successful property investor and developer who has probably educated more successful real estate investors than anyone else in Australia. So we look forward to hearing Michael's views on strategic property investing. So without further ado, I'll throw you across to yourself, Michael.
Thank you very much. And there's one thing you left out in my bio. I'm also a client of Wilson Pateras, and a very happy one. So thank you very much for looking after our affairs, because you understand those things well. So what we're going to discuss today really is the current state of the property markets and what's ahead. And it's not really what the news is telling you. I'm going to share with you a number of the big game changers that have changed my view on what's ahead for property. And even in the last week, I have changed my view on what's ahead, even in the short term. I'm going to explain why there's a perfect storm of positive factors brewing for our property markets, and really what, if you're interested in creating wealth through property, what you're going to have to do to do differently. And you will have to do things differently to the average investor, because, as I'll show you in a moment, most investors don't get to where they want to financially in property. Nicholas has explained a little bit about what I do and who I am, but I have a team of property strategists, buyers agents, property managers, wealth advisors in Melbourne, Sydney and Brisbane. We currently manage over $2 billion worth of assets. So it's not just theory, we actually know what's going on the ground. And this year alone, my team has been voted 3 times, 3 different national awards, as Australia's leading property strategists. Now, last week, this is the headline that came across my news feed last week from News.com, which is a very big site. Australia's housing market could see a historic crash. That was last week. And interestingly, it was clickbait, and I got sucked in and I looked at it, and a naive young journalist took the story from somebody who put it out there, and then she got a number of, I guess, experts chasing a headline to corroborate that. But it's not true. But you know how in those articles they give you links to other articles, same day, same news site said this. So one article said we're going to have a crash, and the other one said, hey, we're in the best time ever. So let us decide what's going on. And I'll tell you what, the second article was more correct than the first. Let's put some context to it. In Australia, there's $7.1 trillion worth of property. There's about 10.5 million dwellings, of which 70% are owned by owner-occupiers. There's also debt against those. But when you look at the statistic at the bottom of that screen, there's $1.86 trillion worth of debt over $7.1 million worth of assets in residential real estate. What that's showing is there isn't that huge, significant debt that you've probably heard that, we're going to have a fiscal cliff that we felt we're going to fall over in September, and now it's going to be March. Yes, some people have overextended themselves. But in general, the debt in Australian real estate's in the hands of those who can afford it, and the overall loan to value ratio of residential real estate is in the order of 28% or so. So actually not a lot of debt against it, and interest rates are very low. And interestingly, the residential market being supported by 70% of it by owner-occupiers makes up a huge percentage of Australia's household wealth. During this pandemic, and we have had a pandemic, and we have had a recession, and we've gotten through the recession, and we've probably gotten our way through the pandemic, residential real estate has been very resilient. This is what's happened to prices in the capital cities. Overall, median prices are not a good indication because there's houses, there's apartments, there's townhouses, there's the CBD that suffered, and there's other areas that have done well. But overall, Melbourne suffered the most, and we're in Melbourne. We know why. We had the lockdown. But other than Melbourne, every state, capital city, is actually at a higher level than the beginning of the year. And if you look back over the last 12 months, even Melbourne, every capital city has a median price higher than last year. We've got through this. This is the most recent figures from CoreLogic, who are now releasing data every week. And Melbourne went up a smidge. It went up 0.1%. So the bottom line really is I believe our statistics, our research shows that when we look back next year, we're going to see that middle of October this year was when the markets turned the corner. But there isn't just one property market. So the off the plan apartments, the new apartments, they're still going to suffer. Some of the outer suburbs are going to suffer. We'll go into that in detail. But in general, we're through it. We got through it. In house values, what has suffered though is rents. Rents have gone down, and in Melbourne, house rents haven't gone down much at all, and vacancy rates are on the low side, but apartments overall have. But in the city, in the CBD, there's a 14% vacancy. In my 40 years in property, I've never heard that sort of vacancy rate. But if you go into the suburbs, it's nowhere near that. And we know that it's the lack of the students and the Airbnb properties that have come onto the market because there aren't tourists there that have affected certain sectors of the market. So home prices, apartment prices around Australia have been resilient. Rents have suffered because in general, those losing their jobs, those suffering from COVID, the unemployment rate going up has been more for the younger people in certain industries, and in general, they were tenants. But as I said,
Michael, Suzanne has a quick question around, and the question is: with the border controls and hence fewer international students, do you expect to see the further cooling off of the market that is often rented by those students?
Yes. So thank you for the question. And please, this is the beauty of this medium, that more than happy to answer your questions. So there isn't one Melbourne property market, and there isn't one Melbourne apartment property market. So if you're talking about flats in Elwood, and many of us are old enough to remember when they used to be called flats, those 2-story, 3-story walk-up ones on a nice block and with an Art Deco look, for example, or even the 60s ones. These easy to rent. They're turning over. If they become vacant, our property management division is able to rent them quickly. But there's nobody going into those inner city apartments. That started already at the end of last year in Sydney in particular, with Opal Towers and those other issues with regard to construction quality. And in Victoria, there were some issues regarding cladding. But if you want to segment the market, you're right. We need to bring the students in, we need to bring the immigrants in, but we're not going to do that till things are safe. So that segment is definitely going to go down. But interestingly, the latest figures, and I don't think I've got them here, in sales, there actually have been lots of new apartments sold and established apartments sold in the CBD in Melbourne in this month alone, in November. And it's first home buyers who can get all these grants and are actually buying up in the CBD. They're not going to make up for all the lost students and lost tourists, but you're right, that is going to be a market that's going to suffer a bit. Thanks for the question. Now, what I'm showing you now is consumer sentiment, this time around compared to other downturns. So consumer sentiment, in my mind, is one of the factors that shows a whole lot of factors. How you feel about your job, how you feel about your financial security, what you think about interest rates, what you think about your health. And currently consumer sentiment has jumped up, and it has never jumped up as quickly through downturns, as you can see from this chart, as before. This wasn't a proper economic downturn. It was a health issue, and we were closed down not because of an economic problem, and that's why we're going to bounce out of it quickly. And this is the forecast GDP growth from the National Australia Bank, but even the Reserve Bank told us we're over, the recession's over. We're not going to know the September GDP figure till December or so. But when we find out that we were in recession with 2 quarters of recession, we're going to be well out of it. And so it's going to bounce.
I've got a quick question from Justin,
Yes.
just on that topic. He's asked, with the current situation with COVID, if we compare it to the recessions of the early 90s and the GFC, are there lessons learnt from those experiences which maybe change the current situation? And they include things like, he suggested, the financial institutions, how they behaved previously, and even the most recent Royal Commission into the lending sector.
Well picked. So what the government's done this time round is get in early. It didn't wait for us to get into trouble financially, economically, or property-wise. Remember, Scott Morrison said, I'm going to build a bridge across to the other side, and he threw everything at it. And so, yes, we were on life support. But guys, your business, my businesses, all had to close down, suffer, but not because of anything we did wrong. And so therefore it was on the government to look after us. So yes, not just Australia, but governments around the world learned to get in early and give financial support. Similarly, the banks did also by giving rental holidays and mortgage holidays. And interestingly, that's worked its way through well. A lot of people are now repaying those mortgages. It wasn't a holiday, you had to pay it. It was a deferral, and so you ended up paying more interest on interest. But what it did, good point, good question, is it stopped the mortgagee sales. Because those of us who remember the 90s in Victoria, the banks took over so many properties. They didn't at all. There's been very, very few forced sales. And that's one of the reasons the property market has remained resilient.
So we're talking about liquidity, Michael, because it seems like in the past, when confidence disappears, so does all the people's sentiment to lend, which is liquidity. So the government has come in and supplemented, or central banks, with liquidity, put more capital in the markets.
More than that, we are stashing our cash. So there's actually more in savings than there ever has been. And it's not because you're getting a good interest rate. So people were cautious. Some people took money out of their super funds when they didn't need to. Some people actually paused their mortgage payments when they didn't need to. Others got government money. Others just didn't spend going overseas. So in general, it's a very mixed bag. There's a whole group of people who've done well and some who are not doing well, not just health-wise, but financially, and that's a real shame. But in general, the rich are getting richer out of this downturn. They've got more money, they've got more cash, and they've got the ability to borrow. So there hasn't been the credit crunch. Remember last time, Nicholas, there was in the global financial crisis, you were worried that there was going to be a run on the money on the banks and people were stashing their cash. Very different. So we have learned and we have matured. And that's one of the reasons, even though there was a significant recession, much worse than the last couple of times, we got out of it quicker and sentiment has recurred very, very quickly. And each of the pessimistic banks, remember, they said our property values were going to drop 10%, 15%, 20, some even said 30%. They've all four banks have done an about face. And this came from the ANZ Bank this week alone, suggesting that at the end of this year, Australia's property markets in general will be up a little bit over the year. And next year, overall, property values, which is that lightish blue bar chart at the end for each state, are going to overall in Australia be just under 9%. They believe that Perth's going to pick up after many, many years of problems. Brisbane's going to do very well. Even Sydney and Melbourne are going to. Look, they're suggesting a couple of states are going to do double-digit capital growth. Not sure that's true, but if the banks think it is, they're going to be more conducive to lending because they feel more secure. Similarly, Westpac Bank a couple of weeks ago came out. These are their forecasts for a 2-year period. In 2 years' time, 22, 23, and they're seeing double-digit capital growth then as well. So what I'm starting to do is give you some context that we've gotten through the worst of the health and the economic issues, and those who own property are doing nicely. Those who are living off the money in the bank, unfortunately, are not getting much return at all. And we're talking about property investment. So let me put some context to it, because in Australia, there are about 2 million property investors. Kate Forbes, one of my business partners, did these charts a couple of days ago because this is the latest statistic, even though it's 2018 tax returns, and showed that of all the property investors in Australia, 90% own one or two properties. In other words, 190,000 own one or two properties, and 21,000 own 6 or more properties. That's all.
And Michael, tonight, 46% of our audience owns an investment property.
Interesting. So when we actually dug down to the clients of Metropole, we actually found that in the blue line, interestingly, we didn't do well compared to average, that few of our clients own one property, but in fact, 7 times more own 6 or more properties. So the answer is you shouldn't do what everyone else does. There is a way of investing. Property investment isn't just an event, it's a process which we'll discuss. And if you do what the average person does, you'll get the results they do. If you do what that small group of successful investors do, you can end up owning your own cash machine. And let me tell you about a cash machine, because many years ago, one of my business partners, Brian Larder, came into me and said, Michael, I want a cash machine. And I said, what? And he says, I want a cash machine. I want to come in the morning and flick the switch and all the money comes out. And then I turn it off at night. I turn off the switch, go home and play with my 4 kids. I want to come tomorrow morning and turn on the switch again and make all the money come out. And I said, yeah, Brian, I want a cash machine too. Now, guys, if we were sitting face to face in an audience, I'd be asking you who wants a cash machine. So there is a chat box there. Maybe if you'd like a cash machine, just put in there, yes, I want a cash machine too. Let me see how many of you would like a cash machine. Because the answer is those people who build wealth through residential real estate do have a cash machine. Their tenants get dressed in the morning, go out, go to work, pay tax, and help pay your rent as well. So if it's possible, why aren't more people financially independent through property? Why doesn't it work? Because not only did I show you a moment ago that those who invest in property, most never get past their second. Of those who invest in property, 50% sell up in the first 5 years. They bought the wrong property, not financed it right. There's a lot of reasons. But the reason most don't develop financial independence in property is because they don't have a big enough asset base. Residential real estate, in my mind, is a high growth, relatively low yield investment. And what we need to do is build an asset base. Some start too late. So we don't sell property, but we give strategic property advice. And if people come in their 50s and 60s, it's hard to build a big asset base. You need a longer runway than that. So others, it just took too long. They didn't buy properties that grew in value well enough or fast enough. They bought the wrong sort of properties, the wrong selection, or got the wrong finance and had to sell when the market turned down. So how many properties would you need to become financially independent? Now, I'm not an accountant like Nicholas, but there is a simple formula. So the formula is how big your asset base is, multiplied by the return, and that tells you what your income is. So let's just do a quick sum. How much income do you want? And let's imagine you want $200,000 a year net after tax. I'd love to say show of hands who could do this, but why not in the chat box say if you would like $200,000 net? Wouldn't you like that cash machine? And it's not the cash, it's what it will do. It'll give you choices in life. It'll give you the opportunity to, I'm not investing for me anymore. And the guys at Wilson Pateras know I'm not actually investing for my kids anymore. I'm investing for, I've got 10 grandkids and one on the way. So I'll have 11 in March next year. I'm still paying their school fees. So it's interesting. So how much do you need? If you want 200,000 and the average yield is 3.5% after agents, commission and rates and taxes, not income tax, you probably get 2.75. So if somehow or other than your home, you end up with $1 million worth of assets, $1 million worth of great real estate, no debt. You've got to pay it all off. All you're going to get is $27,000 a year. That's not much. So you need $10 million worth of assets and no debt to get $275,000. And then you pay tax and then you may end up getting where you wanted to be. So you've also got to own your home with no debt. By the way, that's not the way to do it. It doesn't work having it with no debt. So you've got to have debt to get going, and managing the debt's a totally different discussion we can explain. But if you ask me, how long will it take to become financially independent through property? Probably about 30 years. That's probably not what you wanted to hear, is it? But the answer is most people make a few mistakes the first couple of years. You've got to undo those, and then you need a few property cycles. Now, what I want to do is give you something, a new report I've just recently done called How to Live the Life of a Property Multimillionaire. And I wasn't sure how to do this. So the best thing is just write this down on a piece of paper. michael@metropole.com.au is my email address. So send me your name and your email address, or I'll just get it from your email. And I want to send you a copy of this report, and I'll explain why. We haven't got a lot of time, but I want to show you what the end game you should be aiming at is. I don't know you. This is not financial advice, but the aim is, in the end, you should own your own home with no debt, and you should have a cash machine. And the cash machine should be a combination of, in my mind, residential real estate, plus your superannuation fund, and I'm not licensed to give you superannuation advice, and plus maybe some shares or managed funds that give you cash. If anyone says property only, better run pretty quickly. Similarly, like if somebody says shares only, be careful. But the financial planning team at Wilson Pateras understands the holistic approach and will actually put a blend together for you. So in the end, I don't know whether the government's going to have capital gains tax or not, whether they're going to have stamp duty or not, whether you're going to be able to borrow in your super fund, what interest rates are going to be. No one knows. What I do know is if you have a big asset base, you'll have choices. And if you don't have a big asset base, you won't have choices. So your job is to build an asset base initially and then slowly lower your loan to value ratios. And because I haven't got time to discuss that with you today, I can't remember, I think it's 40 pages in this, but I'm more than happy to gift that to you as clients of Wilson Pateras. So just email me, michael@metropole.com.au, and I'll get that report to you. Now, if I could explain why I'm positive about property, I believe we've got a whole lot of factors confluencing, if that's a word, coming together that's going to make our property markets strong next year. And there's, first of all, the state and federal government spending. We know the federal government's doing things. The state budgets are starting to come out. They're going to next year, like they've already through this year, helped us. They're going to want to get jobs and the economy picking up. We've got historically low interest rates. Many of you will remember that the global financial crisis, not that long ago, interest rates were 10%. If I got a mortgage rate under 10% for my home, I would have been thrilled in those days. And as interest rates have gone down, property values have gone up. Property investment is a game of finance with some houses thrown in the middle. Even property home ownership is basically dependent on the availability of finance. So over the last couple of decades, finance became very cheap. And at the same time, there were more two-income households. We're earning more, maybe not this year. So that's what pushed up property values. So historically, low interest rates will be helpful. But the big game changer was when Josh Frydenberg came out and said, next year, the banks are going to have the shackles taken off and they're going to be able to lend you more money. And easy credit approval is going to be a big game changer that's going to let the average person borrow more. They're not going to look at your Uber Eats accounts anymore. They're not going to see what you're spending your money on. You're going to be responsible for your lending capacity and what you can borrow and your serviceability. And easier lending always leads to higher property values. That's just the way we as humans work.
So just on that point, Michael, that's a recent change, isn't it? So the regulator made things more difficult by assessing what you call actual living expenses, but now they're reverting back to the.
That's the plan. So very much so. So post global financial crisis, they made it very hard. Look, if they hadn't, we could have gone the way of America with those dummy loans. So there is good reasons why they did that, but they went overboard. And then the Haynes Royal Commission a year and two ago scared them as well. So what's happened is it's very, very hard. And we see lots of clients who've got good equity and even a little bit of serviceability, but they can't borrow. So things are changing. And Josh Frydenberg said that's starting in March next year. At the same time, all these things coming together is increasing consumer confidence. And in due course, there'll be the return of immigration and students coming. And there's also going to be a return of international demand for property. What are all those people going to be doing in Hong Kong? I mean, Australia's and New Zealand are really the poster children for how to work through COVID and the security and the stability of our governments. So we are going to probably tax them very heavily, as we've done before. No big deal about that, but they're still going to put their money into Australia. And when all that happens, population growth is going to return. But in the short term, there is a lack of population growth. So a couple of people have asked, what lessons do we learn from the past, from the global financial crisis? And I recently did a report on 40 lessons I've learned. I've actually been in property, it's almost 50 years, but I could come up with 40 good lessons quickly. So apart from that other report that I'm going to send you, which is how to build a portfolio and what the end game should be. If you want to learn 40 lessons from the last 40 years, same thing, just send me the same email. You ask for one, I'll give you both reports. That's easy. But out of that, I want to show you a couple of lessons now. But michael@metropole.com.au, just send me an email saying report, please. I'll know what it's about. The first lesson is perfect timing has little impact on your investments. That's one of the lessons in this report. In other words, I think we're past the bottom. Doesn't matter. The bottom is 1 day, 1 week, 1 month. If you own the right assets, owning them in the long term is going to be much, much more important than getting a one-off hit because you got a $20,000, $50,000 cheaper.
And Michael, just on that topic, is it fair to say that historically the volatility of residential property prices, meaning the peaks and troughs, tend to be less accentuated than, say, a share market, which tends to rise a little bit more quickly and drop a bit more quickly, and therefore the tops and bottoms in residential property tend to have less relevance?
That's part of it. But the other factor is more important is the asset you own. So the reason it's less volatile, Nick, is because it's much harder. It's illiquid. It takes time to sell and there are taxes in and out. So basically, if you own an asset that increases, so we've got statistics going back for every state, every suburb, 40 years. Houses, for the last 40 years. And on average, Melbourne and Sydney grew just over 7% per annum over 40 years, not every year. There's long periods when there's not much growth, and Brisbane grew just under 7% per annum, which means on average, properties doubled in over the last 40 years, every 10 years. But if that's the average, that means half did. It also means half didn't. And so you've got to own the right ones. But if we can outperform the averages, which I can do in property, I can't do in shares, so it was a good example. And so rather than the 7% growth, you can actually get a little bit better growth. What happens is your asset just keeps growing and the gap widens and gets wider and wider. At the beginning, it doesn't look much different if you own a property in a good suburb of Melbourne or you own in the CBD, but year after year, the gap changes and the rent increases as well. We all have a financial capacity. We all can only borrow so much. So you only should own investment grade, not investment class properties, good properties that give wealth producing rates of return, but also you should only own diamonds. In fact, you should only own pink diamonds, the best sort of assets. And once you do, just hold them for the long term, because time in the market is critical. So this is another chart which shows that if you buy a $500,000 property that increases by that average of 7% per annum for the 3-5 year periods, in the last 5 years, almost half the growth occurs. It's, like that compounding of the lily ponds, where one lily becomes 2, becomes 4, becomes 6, and the last duplication, it fills up the whole pond. So get the best assets you can and hold it for the long term. Another lesson I've learned over all these years is that no one really knows what's going to happen to property markets in the short term. In the long term, I can tell you they're going to revert to the mean. In the long term, I can tell you it's the wealth of the nation that's going to allow certain areas to outperform. But in the short term, we've seen all the experts, despite all the data, got it wrong. And the main reason is because property markets are controlled by humans with emotions, with behavioral biases, who make all sorts of financial errors because they invest or buy their homes emotionally. But a real big lesson to learn is there's multiple property markets around Australia. There's not just one Melbourne market, because the apartments in the CBD are working differently to the flats in the middle ring suburbs, different to the house and land packages in the outer suburbs, different to the houses in the middle ring or the villa units. So if somebody says Melbourne is doing this, no, it's not. So what you've got to get much more granular at the moment. Another quick lesson is that strategic property investors don't just buy and hold, they manufacture capital growth by renovating or developing. So my preferred strategy is to buy an older, it depends what your budget is, apartment, and renovate and put a new kitchen and bathroom and split system air conditioning. And you're not paying for those fancy new apartments. You're buying one that's built out of solid brick, not paper mache, that's going to be in strong demand. Or I guess my preferred strategy is actually developing townhouses, which I keep. Another quick lesson is booms never last forever. Neither do downturns. So we're going to have an upturn now, but set yourself up, because property investment is a process. It takes time. See the guys at Wilson Pateras to get the right ownership structures. Make sure your finance sees you through in the long term, not just the short term. Our clients buy time, not just property. And they buy properties not just for the cash flow, but to be able to buy the next property and the next property. And that's why they actually want the right finance in place, and also the right sort of property that grows in value. And stick to a proven strategy. Most people don't have a strategy. Buying a property is not a strategy. Searching on the internet is not research. There's very different. So what's going to happen post-pandemic? What sort of property is going to be in continuous strong demand? As I said, don't make long-term investment decisions based on the last 30 minutes of news. It's basically buy the sort of property that's always going to be in strong demand by a wide demographic of owner-occupiers and tenants. Because I see moving forward, we're going to have a two-tier market. I was speaking with Nicholas just before we started. In both cases, some of our clients are doing really, really well. COVID hasn't affected them much. And in other cases, some people are really suffering badly. And the middle class is gone. A lot of Australians think that the wealth distribution is a bell curve. It's not. We're actually getting less of the middle class and more people at either end. And the wealthy people can borrow, and to borrow $1 million at 2% costs them $20,000. They're going to be able to buy more of those better quality properties, and that end of the market is going to pick up, and the lower end is unfortunately going to suffer. We have realized during COVID that there's the importance of neighborhood, and let me call it the third place. Your first place is your home. The second place is where you work. And the third place that we all missed in Melbourne was the third place, the neighborhood. You couldn't go to the gym. You couldn't go down the street to the cafe. You couldn't go to the movies. You couldn't go to the park and see people. And people won't forget that easily. So up till now, Melbourne has basically been, and all our capital cities, like a fried egg. The yolk's in the middle, and people would travel out. But the millennials are no longer going to want to live in the CBD, and it's going to be more like a scrambled egg. People are going to want to live in locations where they're going to be 20 minutes from a number of good schools, a number of good cinemas, the gyms, their third place. Neighbourhood is going to become very important.
Michael, interestingly, to what extent, for instance, for people who work in offices, who more likely than not will have probably part-time or at least full-time even work from home arrangements, will things like that in the short to medium term have an impact on property? And if it stays like that permanently, where people will do work under those arrangements, will it have a longer term impact in the sort of the light of what you're talking about here?
Sure, very much so. So some people will go to regional Australia. So if we're talking Melbourne as the majority of our audience is here today, some will go to Geelong, some will go to Ballarat, some will go to Bendigo. Not many, not enough to move the needle. They were looking at it, they were searching during lockdown because they wanted to get away, but now we can get out again. But they're going to recognise that working from the kitchen table, Nick, is not good enough anymore. Working from the dining room table isn't good enough. Open plan living, which is the way we were going, isn't going to work. So you're going to want a separate Zoom room. You're going to want a separate home office that you can close and leave. So one-bedroom apartments will have their place, but most people are going to want at least two. When you get a partner, you're going to want a second bedroom so that one of you can work from home or whatever. When you have a child, you're going to want 3 bedrooms. So the sort of accommodation is going to change. And people are in general going to, I believe, have that blend of working from home and from the office more. So neighbourhood's going to be important. The CBD, if there aren't as many people there, won't need as many hairdressers, not as many clothes shops, not as many cafe bars, but our neighbourhood's going to be very important. So that's going to be one of the criteria we have always used in looking for where investment grade locations are. But the inner suburbs can have this walkability. The inner suburbs can have a 20-minute neighbourhood because they're dense and they can have a diversity of things. The outer suburbs just can't because they're not dense enough. And you will have one Aldi, you will have one Coles, but you're not going to have a choice of Aldi, Coles and Woolworths. You're not going to have a choice of 4 gyms. And if you want to meet a new girl, a new partner, or male, I'm sorry, well, you're going to want to go to Brighton or to Fitzroy or to Elwood. You're not going to want to take them to the outer suburbs.
It's an interesting change in terms of perception of need, because previously people would often want to be closer to the city because the public transport to the city was better. But what you're suggesting is they maybe want to be close to the city just because the local neighbourhood amenity is better in those suburbs.
So public transport is still going to be important, but maybe people will drive their car a little bit more. But people's values, and all this is done is bring forward things that we were starting to do anyway. You and I were using Zoom for our clients, but not as much as now. And we've always liked the fact that you could walk down the road to get your latte or whatever, but nowadays it's even going to be more important. So yes, the inner and middle ring suburbs are going to be important. And there's a reason why. The wealthy people are going to be there. And they're going to buy properties like yours to push up the value. But just as importantly, the tenants are going to be wealthy. There are 2 groups of tenants: those who rent for lifestyle and those who rent because they can't afford to buy. And we have found that during this difficult time, a lot of tenants are 1 or 2 weeks away from broke. They spend a third of their rent on, third of their income on rent. We see that in our property management department. So they can't afford to pay more rent.
Is it fair to say that lifestyle investor is potentially also someone who will recognise, they'll say, I'll rent in the area that I perceive is the right for my lifestyle, but I'll still invest in property, but as a property investment specifically, not
Very
a lifestyle
much so.
choice.
That's called a rent-vestor. That's very true. Now, interestingly, the second last development, I finished 2 townhouses in Bentley. I've got 2 interesting tenants. The first one is the CEO of Hitachi, Australia. It's a corporate tenant. He's very wealthy. And when the rent review was due, because that complex was finished 2 years ago, the rent went up. And the second was this managing director of a very large estate agency that everyone would know the name of here. And I thought, why is this guy wanting to rent from Michael Yardney? And I don't normally look at the rental applications, our property management do all that. But when I saw the name, I thought, this is interesting. And interestingly, he had was renting it with another lady, his new partner, with a different surname. So he'd broken up and he was renting for lifestyle, not because he was poor, but because that suited what he was doing at this stage of life. So we wanted to find areas where the affluent people want to live, pushing up values around you, and also where the tenants in the future, because your future income is going to be dependent upon your tenants' ability to pay you more. So do you want tenants who are going to, it's not a judge of people. This is not a social argument. It's unfortunately the truth, though, that the rich are getting richer. And do you want tenants who are 1 week away from broke? Or do you want tenants who actually have probably got multiple sources of income? Like you said, they've got their own investment properties elsewhere.
And what potentially validates that conversation is that we hear sort of more internationally around the discussion of a thing called universal basic income, which is the call towards providing a basic living wage to all people who may be in a more disadvantaged position, which suggests that they're going to be, as you're saying, probably just paying the rent, not able to pay a premium versus the more sort of wealthy, affluent type.
Very much so. And also it's going to be difficult to increase their rent. So when we select an investment property, I'm going to finish off now. I'd love to take any questions, is we use a top-down approach. So location does 80% of the heavy lifting. So we look at the right state in the property cycle, and we only invest in the capital cities. Sure, there's going to be growth in Ballarat and Bendigo and the Gold Coast and the Sunshine Coast, but why fight the big trends when the bulk of the economic growth, the bulk of the jobs growth, the bulk of the population growth is going to happen in the capital cities? So we look for areas where there's going to be economic growth, because economic growth leads to population growth, leads to wages growth, leads to demand for properties. We look for suburbs where gentrification is occurring, where younger people are moving in, the older people are moving out. The cafes are now selling those cold pressed coffees, and the lattes are different, and soy latte and almond latte. You can see the streets, you can see the transformation. That actually means the suburb is going through a growth in the cycle, not just the state. We look for areas where there's a high percentage of owner occupiers rather than the CBD. We look for those neighbourhoods we're talking about. We're looking for demographics, high walk score. And then within that location, we look for the right property. One with strong owner occupier appeal, not that we're wanting to sell it, but that's going to appeal to good owner occupiers that could buy similar properties, and to tenants who want the same sort of thing. We look to buy below intrinsic value. So we don't buy new, we don't buy off the plan, we don't sell any properties strategists, because we don't want to pay these high premiums to the off the plan developers. We look for scarcity, something special, something unique, something a bit different. So at the moment, you're going to need a balcony if you buy an apartment, but it's got to be a usable balcony. You're going to have to be able to put your barbecue out there, things like that. We're looking for a high land to asset ratio, the land that goes up. So we love villa units in Melbourne. We haven't bought many apartments in Melbourne for probably about 8 years, because they haven't worked very well in the way of apartments. We look for something with a twist, something a bit special, something a bit unique, something a bit different about it. We like properties to which we can add value, and we like the sort of properties that have got the right layout and the right maintenance, low maintenance. So overall, in summary, we're through the worst of it. Are there still going to be problems? Yes. Should you, if you're in the right financial position, consider getting involved in property? Definitely, because all those forces are happening next year. And in March, April, when credit is suddenly looser, there's going to be another wave. So I see a window of opportunity. But you shouldn't try and do it on your own. If you're the smartest person in your team, you're in trouble. I know we've helped a number of clients from Wilson Pateras. So what I'm offering is, if you'd like a free initial discovery call, you got my email address for those 2 reports anyway. You can just say to me, let's have a chat. It won't be with me, but it'll be with one of my fellow directors. You'll be speaking to a director as a client of Wilson Pateras, and we can just have a chat and see if we can help you. So Nicholas, thank you for allowing me to say that. I see there was a couple of questions. Do you want to just direct those questions? And if anyone's got any other questions, please, let's have a talk about that.
Yeah, look, thanks, Michael. It's been fantastic. Lots of information in a very short period of time, and we could talk about property forever. So we appreciate you trying to get a lot of content and information in a very short period. One of the questions that we have here is around going back to that regional area property, and the attendee here has asked, is investment property in rural Victoria, such as Ballarat, a good move in the short term. But I think that conversation can also be extended for places like Bendigo and Geelong, where there perhaps is a regional centre where there are some facilities. There's known and established facilities for people in those particular areas.
So the question really is, where's the highest and best use of your money? And the only reason you would invest there is if you can't get into the big capital cities. But I bet you in 10 years' time, if you look back, you'd rather own something in Melbourne, Sydney or Brisbane than in a regional spot. So you've heard that concept of putting the big rocks in the jar first. So I would rather you buy in Brisbane, which has got more upside than Ballarat or Bendigo or Geelong. Yes, they have done well and they do have multiple growth drivers, but why fight the big trends when the majority of the growth in the next decade is going to occur in the capital cities? Remember, Australia's government has got a business plan. The business plan is to increase our population to 40 million from 25.5 million in the next, it's by 2040. Now, by 2050, by 2030, we were going to get to 30 million. It's now suggested it's only going to be 29 million. We're going to lose 1 million people because of the lack of immigration. But we're at 25.5 and we're going to get to 29. We've still got 3.5 million people coming. I assure you, they're not rushing to go to Ballarat or Bendigo or Geelong. They're coming to our big capital cities.
A question from Paul is, we've talked today about direct property investment. What do you think of property trusts? Obviously, there's listed property trusts, there's unlisted property trusts. What are your thoughts around those type of property investments?
Well, they're not property investments. They are managed funds. And is it appropriate in your super fund or things like that? I'm not licensed to advise you on that. But I believe direct property investment is better if you can afford it because of control, because you can actually do it up, you can change the property manager, you can add value, and you don't have to pay all the fees. So property trusts, some are open-ended, some are you can't get out of, and they have to, if they are listed, have quite a lot of expenses in A, running them, and B, just being listed and compliance costs. And that's coming out of your pocket. Yeah. So to me, they're not. If you're looking for cash flow, then probably looking at good shares would be better than a property trust. That's not a residential or commercial property investment.
What we see at Wilson Pateras is that we see people who may invest in equities type investments, property trusts, etc. They tend to be invested with less or no gearing. What tends to happen with property investments, in probably I'd say the majority of cases, there's a level of borrowing from a bank to support the investment. So I'm guessing that typically means you can probably get a larger exposure to the asset class because of that borrowing or gearing.
So the other thing is, I didn't answer I just looked at the question and answers carefully at the moment now. The question was investing in rural in the short term. Property investment is not a short-term investment. The costs are too high. So yes, you may get a one-off hit. No argument about that. And it probably will do a bit better than some suburbs. But remember that chart of capital growth, and if you can outperform the averages in the long term, that's the way you're going to get that asset base. Because remember, you need to build a big asset base, so short-term thinking doesn't work. During the difficult times last year, during the difficult times this year, I kept telling our clients, don't do what works now, do what always works, whether it's in the share market, whether it's in the property market. Don't fight the big trends.
Yeah, excellent. Well, one question I've got actually for you, Michael, is what difference do you see between people who choose to take advice for investment and those that maybe are wanting to try and do property investment on their own without advice? What's the difference in the sort of the thinking of people in the category who would be more, I guess, more ready to come and talk to a professional like yourself?
Sure. Well, the answer is that most property investors fail. I already explained the statistics, that there's 1.9 million people getting one or two properties. And in the whole population of Australia, 21,000 taxable units. So, you know, Nicholas, personally, I've got a number of taxable units that owns more than 6 properties. So there's not that many families who've done well. So We see this a lot with very intelligent people. We see this with people who've been very good in their own business and they then have difficulty asking for help elsewhere. So just like I ask for your help in making my accounts work right and getting my BAS statements right and not missing anything that I'm missing, I think it's important to get a good team around you. And you actually need a holistic approach. So there's a lot of people at the moment who are buyer's agents and they're enthusiastic amateurs, but they haven't been around long enough. There's people who are called property strategists and they will help you also. But I think you need somebody who understands tax, who understands finance, who understands estate planning, who understands passing on your assets to future generations. And so when we see our clients, it always starts with a plan, because buying a property isn't a plan. So we actually work out, where do you want to be? What are your timeframes? What are your risk profile? And then what's realistic and what's possible. So most people can't plan on their own.
Often when I'm talking to clients of our business, I often refer it to as starting with the end in mind.
Exactly.
Trying to imagine what your future needs to look like financially when it comes to lifestyle. That translates to capital sum. Then you go all the way back to now and say, well, what do I need to do to achieve that capital sum?
Sure, exactly. So you've got to work backwards and see what's realistic or what you've got to do different.
A question here from Peter. Thank you for your question, Peter. The question is around commercial property and yields in commercial property. So the question is, please detail what is considered to be acceptable, reasonable yield for a commercial property, and how is such yield calculated to then translate back to a value?
Right. Well, good question. So let me remind you that commercial property is very, very different to residential. Commercial then is retail, offices, and warehouses. So there's a number of subsets of commercial property, and they're all doing a bit different. Commercial property rents go up in general by the CPI. So therefore, if you're going to buy commercial property currently, the rents are unlikely to go up much. In the medium term, interest rates are going to go up. I hope they are. I know most people don't, but they're going to go up when the economy picks up, when the value of my properties go up, when people's wages go up. But when interest rates eventually do go up, value of commercial properties are going to go down because they're yield based. So people are going to be able to get more money in the bank. So they're going to expect more from the commercial property, but you can't put the rents up. So yields, the values go down a bit. You asked a moment ago about how yields are calculated. Well, it really depends upon the future value, perceived value of future income and the security of the lease. And at the moment, valuers are very, very confused. They don't know how to value commercial property in retail, because what's going to happen post-COVID, how many shops are going to be vacant, how many people are going to go back. They don't know what's going to happen with office, because we know that there's going to be a lot of vacant offices. So they're putting a huge risk premium on their valuations. They're valuing them very low. So while I own a substantial commercial property portfolio of retail, industrial and offices, this is not the time to buy, because there's a bit too much uncertainty. And those who are buying them naively on almost residential yields. So you're finding them buying good commercial properties on 3-4% yields. And that's not the way commercial property should be. They're net, they're not gross, but that's not the way commercial property should be valued. So I can't answer you what yield you should be getting, because it depends upon, is it office, retail, industrial, and how secure is the tenant and the length of the tenant. All that makes a big difference. And I found commercial properties in the 1 to 2 million price bracket are being bought by a lot of people because they got that money in their super fund. They're buying it cash, they're borrowing a little bit on much lower yields. Once you get above 5 million or so, you're playing with more professional investors. And on that basis, the yields change to maybe more realistic yields of what's expected.
And our final question for this evening is relating to land tax. So the question is, land tax seems increasingly to be a financial impost and could almost be prohibitive. I guess it is a problem, land tax. We see it increasingly amongst our client base. It's an incredibly large cost for people who hold significant land holdings. So as an example, Michael, if somebody accumulates a certain type of a certain level of land, say here in Victoria, they get to the highest land tax rate. is it, do you look at other property markets on the basis of land tax, or
Yes, we
other
do.
states
It's
rather?
one of the things we put in the mix when trying to get people a strategic plan put together. So interestingly, trusts are taxed differently to personal holdings, and they're taxed differently because remember, land tax is a state-based tax. So you don't invest for tax reasons, but thank you. It's an anonymous person, so I don't know your name, who left that question, because it is a cost of doing business, and my land tax is horrendous and it's gone up a lot. So can you get around it? Yes, you can buy in different states. You may not want to buy in a trust and pay more tax, but on the other hand, you're not going to get the asset protection and the lifelong being able to pass on the assets to other people. I sort of treat it like a wealth tax. I don't like it, but if I was going to open up a retail business, and I have no intention of, in the old days, I would have said I'd open up in Chadstone Shopping Centre. I'm not sure I'd open in a shopping centre today, but I'd be prepared to pay the highest rent I could to get the best flow through of traffic, foot traffic, to make my business successful. So I'm prepared to invest in the best suburbs of Melbourne to be able to get the asset that's growing, that's giving me and my family financial security. And it's just a cost of doing business, just like my rent for my offices are, and the rent if I had a retail business. So it's one of the things we put in the mix, but it's nowhere near as important as the return of your asset, how well your asset is working for you.
So what you're suggesting is that a quality asset purchase in property, the increase in value over a long period of time will outstrip the cost of the land tax.
Well, your land tax is going to go up as well. But yes, the land tax is a cost of doing business. So you're in Richmond. I'm in Brighton in our offices. We've got expensive offices because it's the right thing for our businesses rather than doing it in the back lane. But it's allowed us to do things well and to present ourselves properly. Similarly, this property business is your business. You've got to own the right stock, the right assets. Then you've got your employees, your properties have to work hard for you. If they don't, you've got to consider, do you give them a redundancy package and get rid of them and pay a recruiter to buy another one and say you go 2 steps forward to go 1 step back? It's just all part of the mix. And yes, it's one of the imposts, but nothing you can do about it.
All right, we'll perhaps leave it there. We're right on 8 o'clock now. Well, thank you firstly to Michael. Thank you so much for today's session. It's been very informative, very interesting. Everyone loves talking about and hearing about property, and we're very thankful for your time. So would love to have you back again at some stage in the future.
Look forward to it.
And all our attendees, most importantly, thank you to you for tuning in today. We appreciate your time, and we know your time is valuable. So thanks for tuning in. We hope you've learned a few insights. Please feel free post this session to contact myself or Christine, our marketing manager, or even Michael directly. A couple of those documents Michael referenced there. If you're able to contact Michael, that's fantastic. Alternatively, we've seen a few people who have asked for us to actually distribute those documents as well.
I'd rather them contact me, because then there could be questions that we could answer out of it as well. We're not heavy salespeople. We're clients of Wilson Pateras like you. So give us the courtesy of letting us help you. You can ask me a question which others don't have access to. Michael at metropole.com.au.
Please feel free to contact Michael, and we look forward to seeing you again soon at the next Wilson Pateras webinar. Have a nice evening.